Welcome everyone to the December edition of the CAFFE seminar series. So we're delighted to welcome today two great speakers. So Elise Gourier from ESSEC Business School in Paris will present a paper entitled Private Market Fund Factors. Then Gianpaolo Parise from EDHEC Business School, Nice campus, will present green window dressing. So thank you, Elise and Gianpaolo, for accepting our invitation. So as usual, each presentation will last 25 minutes and will be followed by 10 minutes of Q&A. And there will be, if we have time, a final discussion at the end. We encourage you to turn on your camera so that it feels like a physical seminar as much as possible. Elise, the screen is yours.
Thank you very much, Laurent. So let me share my screen. All right. So the paper, thank you very much for the invitation. I'm very happy to be here. The paper I'm going to present is co-authored with Will Gutzman from Yale and with Ludovic Philippou from Oxford. So it's a paper on private market funds. So until about 20 years ago, private market funds were almost exclusively private equity funds. And then in the last 20 years, there's been new asset classes developing as private market funds, and these included real assets and private debt funds. So why are private market funds important? Simply because they've become an increasing part of institutional investors' portfolios. So in 2022, private markets accounted in terms of assets under management for over $12 trillion. And as you can see on this graph here, what is displayed is the allocation of US pension funds since 2001. So in 2001, there was over 90% of assets that were allocated to fixed income and to public equities. And the remaining 10% were basically 5% allocated to private equity funds and 5% allocated to other alternatives. So this picture has been changing a lot in the last 22 years. And in 2022, basically private equity funds accounted for 13% instead of the initial 4 to 5% of pension funds portfolios. And in contrast to this, fixed income and public equities have been decreasing from about 90% to about 65% of pension funds portfolios. So basically, private market funds have become more and more available to all investors, so institutional investors, but also retail investors. And portfolios have, well, there's been more and more demand for this type of funds. So newer asset classes such as real assets have developed, while initially the initial private equity funds were distinguishing assets based on the level of maturity of the firms, the newer asset classes were more about the focus of the investment. So initially, private equity included leverage buyouts, which were investments of majority stakes into mature firms, and venture capital, which were investments of minority stakes into younger firms. Now, if you think about real assets funds, so real asset funds are funds investing in natural resources, in real estate, in transport, infrastructure. All these funds, it's unclear whether they're investing in mature or in young firms. So while initially the categorization of private market funds was done according to the level of maturity of the firm, what has been done more recently was to categorize asset classes and private market funds based on the focus of the investment, so real estate, infrastructure, or natural resources. But all these investments might be majority investments into mature companies, so they might very well be LBOs. So basically, it is very unclear whether the new asset classes are redundant in terms of risk-return profile with the old asset classes or not. So it has been argued, it has been advertised, as you can see in those quotes here, that the new asset classes are providing investments with lower correlation to equity-like asset classes than the investments that were available before. They're supposed to provide investments that have higher income than bond type of investments, superior risk-adjusted returns than equity types of investments, but none of this has been really proven. So now what do we do? What we do is that we propose a methodology that explores the factor structure of private market funds in order to understand whether these new asset classes, whether the funds that we have are redundant or not with one another, and how they compare with the factor structure of listed equities. So what we have is an unbalanced panel of asset returns. These asset returns are smooth, so I'll get back to that and explain to you why in a second. So there are quite a few challenges to address in order to explore the factor structure of these funds. Once we have developed this methodology, we apply it in order to build some private factors, and we assess whether these factors are spanned or not by public market factors. So what are the challenges that we have to address? First, the data set that we have is a data set that is called, the data provider is called Burgess. It's a data set that contains cash flows of funds. So we have irregular cash flows of funds which have a limited life. So we have a highly unbalanced data set. The data set also contains net asset values that are evaluated by fund managers. So it's appraisal-based valuation, and this valuation is subject to biases and is subject to smoothing. We have some investments that can span many industries and many strategies. And basically, we have investments that we can only buy. So it is not possible to short a private market fund. So if you build a portfolio of private market funds, you can only buy those funds and not short them. What we do in order to address these challenges is that we build a clustering algorithm in order to group funds into categories that have similar risk-return profiles. The latent common return components within each category is going to be our private factor. So let me get to the data, and then I'll explain to you what we do with this data and how we build our model. So the data set that we use is from Burgess. So the Burgess data set contains data on about 5,000 funds, and these funds are classified into 12 categories. So the way it works for each fund is that, so as if you're the investor, basically when the fund starts, you have to commit a certain amount of money to the fund. So the start of the fund is called the vintage year. Then the fund manager is going to search for investment opportunities during a period that lasts about 5 years. And whenever they find an investment opportunity, they're going to get back to you and ask you for the money. So during this investment period, the fund manager is going to invest the money that you have committed at inception of the fund. Then after this investment period, there's a period during which the investments realize, and the general partner, who's the fund manager, is going to exit from each of their investments when they think it is the moment to exit. Once they exit from the investment, the money the capital is redistributed back to the investors. So the GPs are the fund managers, the general partners, and the LPs, the limited partners, are the investors. So what we have is the time series of cash flows and of net asset values from the 80s until 2018. We focus on the period since 2003, because before, all these new asset classes basically didn't exist. We have some fund characteristics for each fund. So we have the vintage year, the year of inception of the fund, the size of the fund, which is the amount, the total amount that was committed to the fund, the geography, and the currency, and the experience of the fund manager. So just to give you an overview of the data set, here, as you can see, we have, so there's about 5,000 funds. About 1/5 of those funds are real asset funds. Real asset funds are decomposed into real estate, natural resources, infrastructure, and some other real assets. Then we have equity funds, which are the majority of the data set. There's over 3,000 funds, which are private equity funds. They contain leverage buyouts, venture capital, and a few other funds. And then we have private debt, which has recently developed as well. There's about 400 funds in private debt, so this is the smallest category, and that contains mezzanine debt and distressed debt. So here too, there's different types of risk return profile. All right. So from the time series of returns, we have to compute a time series of, well, sorry, from the time series of cash flows, we have to compute a time series of returns, right? The returns are not observed in private equity. So the way we compute a time series of returns is that we calculate the modified internal rate of return under some assumptions for the financing and reinvestment rate. So each quarter, we end up with one internal rate of return, which is going to be the return of a given fund over this quarter. We use the net asset values in the calculations of the returns. So this is a very strong assumption to assume that the net asset values contain valid information that we can use to calculate the returns. It has been shown in a paper, well, in several papers, but for example, in the paper by Jenkinson and co-authors, that the net asset values are quite accurate in terms of estimation of the fund value. However, the net asset values, if used in order to infer the returns, lead to returns that are highly autocorrelated. So why is it the case? It's an issue that is fairly common in illiquid assets. So it's an issue that has been explored a lot in real assets, in hedge funds, for example. So basically, if assets are illiquid, the way the asset manager is going to evaluate the value of an asset is that they're going to look at other assets around them that are similar or considered similar to the asset they're trying to evaluate. They're going to look at the last transactions, and that's how they're going to assess basically the current price of their asset. And this is going to lead to returns that are autocorrelated. So there's an entire literature that explores the issue of autocorrelation in illiquid assets. There's different ways to remove the autocorrelation. The easiest way is simply to fit an autoregressive or a moving average process. But it has been shown by the recent paper of Kutz, Gonzalez, and Rossi that for many asset classes, it is actually not sufficient to just remove the autocorrelation at the fund level. So I'll get back to this issue when introducing you the model. But in our case, it is not enough to remove the autocorrelation at the fund level. So we will also need to remove the autocorrelation at the asset class level, which is an issue for us because we do not trust the asset class as self-declared. So what we do is that we recategorize the funds into homogeneous groups of funds based on their unsmoothed returns. Okay, so let me present you the model. We've been working a lot on the model. It's been changing quite a bit over time. So let me introduce you to the model. So we model the true returns. So those true returns, we do not observe them. We model the true returns as the sum of a mean component that is specific to the fund. So I denotes each fund, plus a group effect. That group effect can follow a given factor structure. The group effect is supposed to be the same within each group. So GI here is going to denote the group to which fund I belongs. And then there's an idiosyncratic return or noise component. And the sum of these three components is going to form the true returns. I'm going to introduce a group index. A group index is simply going to be a portfolio. So we take the portfolio to be equally weighted, but there can be different choices that are made. A portfolio of funds within a given group. So you take the group GI, the group fund I belongs to. You take all the funds that are in that group and you form a portfolio with those funds. the return on the portfolio is going to be denoted by R bar GIT. And basically what we're going to assume is that the fund manager, when forming their expectation of the fund value at time t, is going to take as a reference point what they believe the portfolio of most similar funds is worth. So we're going to assume, like in the paper by Coates and co-authors, that fund managers receive different signals about the group effect, about the group components alpha, and about the idiosyncratic return epsilon at each time t. We're also going to assume that these fund managers are Bayesian agents. So they're basically going to treat those signals, to use these signals in order to form expectations of what is the true return of, what is the true net asset value, what is the true value of each fund at time t given these signals. So Coates and co-authors have shown in their paper that under this set of assumptions, and if using the portfolio return as a reference point, the observed returns can be written as a moving average process. So basically, the observed return is going to be the sum, the weighted sum of this reference return plus the difference of the true return, the lagged true return of each fund minus this reference return. So basically, the agent incorporates the information they get, the signals they get on the group effects and on the idiosyncratic components. From this, they form their expectation on the net asset value of the fund. And the observed returns, the inferred observed returns, are going to be the weighted sum of this lagged reference return plus the difference between the true return and the reference return. And the true return is going to have an autocorrelation that is equal to 0. The sum of the weights, so the sum of the weights in front of the difference between the true returns and the reference returns has to be 1. And the sum of the weights in front of the reference, the lagged reference returns, has to be 1 as well. So what are the strengths of this model? The first strength is that the groups of funds are going to be estimated as part of the model estimation. So we're not going to assume that the asset classes that are specified in our data are the right asset classes. We're going to let the data talk. The group trajectories, the alpha term, is going to be left unspecified and is going to be estimated as well as part of the model estimation. This model allows for missing observation, so it allows for an unbalanced panel of data. It also allows for funds having different time spans. We have a fund level specification, so we can recover the fund level returns. So let me get to the results. So we basically estimate the model. It's a maximum likelihood estimation. It's an estimation in 2 steps. So conditional on the cluster, we estimate the model parameters. Conditional on the model parameters, we estimate the clusters. And we basically iterate this process until convergence. We end up, the estimation, what the estimation yields is the group that each fund belongs to and the model parameters. So we can try and understand basically the different groups of funds that we obtain. Each group of funds is basically has the same group component, has the same return component. And what we find by running a multinomial logit regression of the relative log probability of being in each group on dummies for fund characteristics is the following groups. The first group is a very broad group of equity products all over the world. So we find a lot of leverage buyouts, US leverage buyouts and European buyouts. We find a lot of real estate funds that are non-US funds and that have an opportunist tilt. So those real estate funds are a bit more risky than the traditional real estate funds. We find a lot of non-US energy funds, a lot of non-US timber funds, and a lot of non-US infrastructure funds in this first cluster. The second cluster, the second group of funds is very exclusive. It contains VC funds. It contains venture capital funds. It contains very few real assets. The third group contains large real estate funds that are US funds. The fourth group contains large distressed funds. So the distressed funds are the most risky funds among the debt funds. The fifth group contains energy products in the US. The sixth group is in an income group. So it contains a lot of different funds containing US real estate, US timber, US infrastructure, basically everything that is relatively safe in terms of risk-return profile. And then there's two other groups that are pretty mixed and hard to characterize. So basically, the first finding here is that the categorization given by the model is not a categorization that is a one-to-one mapping of our asset classes. It's a categorization that takes into account the geography and the strategy of the funds. Many real asset funds are both with the first group of equity funds and the last group of income funds. So real asset funds are not very well characterized. There's a lot of redundancies between the initial equity, private equity asset class and private debt asset class and the new real asset classes. Now, how do the common component within each group compare with the factors that we have in the literature of listed assets? So here we simply run a regression of each common component in our groups on the traditional factors that we find in the literature. So the Fama-French factors, and we also look at the AQR factors, so the quality minus junk factor, and the betting against beta factor. What we find is that so a lot of the loadings are statistically significant. So there's loadings on the market factor that are the statistically significant loadings are the ones that are in bold. So you can see a lot of them are in bold. What is pretty striking is that a lot of the factors that we find are positive and statistically significant on the betting against beta factor, which has been referenced in the literature as being very close to actually private equity investment. So there's nothing surprising here. The R-squares vary from 18% to 72%. So you can see that the distressed debt factor has an R-score that is very high when regressing it on the listed factors. By running asset pricing test, what we find is that private factors do not subsume public factors and vice versa. So it seems that there is no perfect spanning of private factors by listed factors, but there are very consequential redundancies between the two sets of factors. So now let me show you how our factors compare to macroeconomic variables. And in particular, it's been argued that private equity funds could be a good hedge against inflation. Here you have the result of regressions of our different factors. Let's focus on this line here, which is on inflation. So basically what you can see is that we find that there's two of our factors that provide inflation hedges. And these are the distressed debt factor and the energy factor. So to the people who argue that all private equity funds are good hedges against inflation, this is not what we find. So of course we haven't used the latest data, and it would be interesting to run our regressions on the latest data. However, based on the data that we have, we find that only two categories of funds provide good hedges against inflation. So let me now conclude. Basically, what we do in this factor is that we develop a dynamic model which accommodates the very complex structure of private equity returns. So we have private equity returns that are unbalanced. We have private equity returns which are smoothed. Our model takes that into account. It basically relates smooth returns to true returns. It is able to unsmooth the returns, and it is able to form portfolios of funds and to cluster those funds into categories that have similar risk-return profiles. Within each category, we estimate one private factor, and we compare this private factor to the listed factors. What we find is that we find evidence of private factors not being spanned by standard equity factors. Thank you.
Thank you, Elise. So we have about 10 minutes for questions.
So I can ask Elise, like, how would I use your findings? Like what do I learn that I didn't know before?
So as a fund manager, what is done is that there is a budget that is given to each of these asset classes, just like if they were independent. So one thing that we're trying to argue is that this is a wrong way to do, because there's a lot of redundancies between the new asset classes, so the real assets, and the old asset classes. And this is pretty obvious, actually, if you look at anecdotal evidence, because a lot of deals are financed, a lot of real estate deals, for example, are financed partly by a real estate fund and partly by an LBO fund. So this seems to suggest that there are redundancies. Here, what we do is that we have a model which confirms that there are a lot of redundancies between asset classes. So one way to go beyond that would be to reallocate the budget of asset managers in order to not have one part of the budget for each asset class, but one part of the budget for each category of fund that we find. And then another thing that we argue is interesting for fund managers is that if you look at this category of funds, for example, so distressed funds, so there's a lot of investments. So distressed funds, they're part of debt funds. There's an R-square of 72% when regressing those funds on listed factors. So basically, a lot of the variation in the returns of those funds is captured by listed assets. So is it worth really investing in those funds which have very high fees, a lot of uncertainty, which are very opaque, when we can reproduce a lot of their variation by just investing in listed assets? So I'm not trying to argue that distressed funds are completely useless here, but what I'm trying to argue is that there are some categories which are probably more useful than others if you want to diversify your portfolio compared to listed assets. And instead of investing, say 1/3 of your budget into LBOs, 1/3 into venture capital, and 1/3 into real assets, perhaps invest part of it into venture capital, which seems to be one of the only asset classes which is very well defined, and then look very carefully at the other categories, but take into account all the redundancies between asset classes.
But at least, like, that's not how, at least how I invest money. Like, basically, what you have in mind is that people first form categories and then they allocate money. But the way a fund manager would invest is actually regressing returns on whatever factor model you believe in, and then making investment decisions based on the outcome of the factor model.
But funds are specialized in a given asset class, right? So as an investor, you're going to invest in a given fund, in a real asset fund or in an infrastructure fund. So here, for example, infrastructure is completely redundant with either fixed income or equity. So is it worth for you investing in an infrastructure fund when if you already invested in LBOs and in fixed income? Here we argue that it's not worth. And actually, in the case of infrastructure, there's other papers showing that they are redundant with LBOs and fixed income.
So is there alpha also? Do these private factors generate alpha compared to the public equity factors?
So yeah, so
That's
this
the
is
other
something.
way of looking at it, yeah.
It's still work in progress, right? So I don't have a definite answer to this because the alphas are very sensitive to the listed factors that we put in the regression. For now, we do find an alpha for most of these factors, but we haven't investigated. So here I'm only showing you the regression on a specific list of factors. We have tried factors, bond factors, for example, and there are also some relations. We haven't tried enough factors to really have a definite answer on the alpha. This is something we're still working on.
But Elise, why go ahead, Laurent.
No, please go ahead.
Like, why do you take a stand on the factors? Just do principal components.
To do principal components, so most of the principal component analysis are based on balanced panels of data. So here, the fact that we have a very unbalanced panel of data, it restricts a lot the types of methodologies that we can use. We have tried to run principal component analysis that are compatible with unbalanced panels of data. The problem is that there's a couple of different methods. They're very recent, and depending on the method we find, we find very different factors. The second thing is that with principal components, you have short positions. So you basically end up with loadings on all the funds, and a lot of those loadings are negative. You can't short a fund. So here we're trying to impose a sort of a positivity constraint on the portfolio that would form.
May I? You commented on whether these funds are inflation hedges, but there was a result concerning credit spreads that seemed quite systematic across funds in the last slide you showed us. So here I see that all the funds, most of the funds.
Yes. So most of the funds have a negative loading on credit spread. That's right, and that's actually something that I believe has been reported in other papers. At least when looking at the data at a period that's similar to ours. So yes, it is true. We find that there's a very negative relation between all the factors.
Is there any explanation, or like, is it a property that can be exploited systematically?
Yeah. So that's okay. I want to be cautious in my answer here because of the data period that we use. So we use a period from 2003 to 2018 now. So we want to extend that data period. The problem is that the data provider wants us to basically get an R&R to give us more data. So we're a bit limited on the data period that we use. I think I would need to have the last couple of years in order to give you a better answer to that question. So there has been actually papers claiming that you can use in a systematic way this negative relationship. I would not put my money at stake.
Elise, I wanted to ask you a question about the persistence. So you mentioned that the returns on individual funds are highly persistent,
yes,
which is why you developed this very interesting methodology. There is just no way, right, to arbitrage, to make arbitrage profit from these autocorrelations.
No, because it's so illiquid.
Yeah, no, I understand. Okay.
Yes,
So
so just to illustrate the persistence here, you have the AR1 loading on the observed returns. So as you can see, for real assets, it's basically around 40%. it varies between 25 and 74% for equity, and it's again about 40% for debt. So it's very high and statistically significant for most categories of funds. And this is also something that it's the case for hedge funds, right? So there's a big hedge fund literature on the persistence. Most of the papers are just removing it using an AR1. It's the same thing for real estate. So then there's a debate of whether one should use a moving average or autoregressive processes, but it's the same type of phenomenon. The problem that we have here is that if we remove the autocorrelation at the fund level and we put the funds together and form a portfolio, then we still have autocorrelation at the portfolio level. And this is a paper by Kutz and co-author. And this basically motivates the model, because if you have a fund manager, so if you have a mechanism where the fund manager receives signals not just about the fund level, but also about the portfolio level or the group level, then you are going to have autocorrelation not just at the fund level, but also when putting funds together into a portfolio. And this is why we need to basically remove the autocorrelation a bit more thoroughly than just by applying an AR1 process.
I mean, I guess my question is, there are frictions. The frictions are not infinite, I guess. Yeah. So there must be like an upper bound to the level of persistence that's consistent with the absence of arbitrage. But anyway, this is for maybe a different discussion. You see what I mean, right? So,
yeah, I see what you mean. Yeah, I mean there are a lot of frictions. The biggest one of being the opacity of the market, right? You don't observe prices, you don't observe returns. You just have access. I mean, we don't even know so much. What is the exact information fund managers have access to? It depends on the funds. It depends on their experience, on their network. So there's definitely a lot of frictions in that market.
Okay, thank you very much. We have room maybe for time for one last question. Otherwise, we move to the next paper. So is there one last question?
Can I ask a question? I thought that most of the alpha for private funds is actually liquidity. So wouldn't it make sense to look or like a liquidity risk factor?
Yes, so we did. The problem is that most of the liquidity factors, so if you take, the Amihood liquidity, for example, factor, they're factors that reflect the liquidity of listed stocks, not the liquidity of private markets. So it's not really what we want, right? So we've been thinking a lot about this, and it's very hard to find something that proxies well the liquidity of private markets. All the liquidity factors that we've looked at, there's actually no real relationship. It's usually either very close to zero. It's statistically insignificant. So we haven't really found much here. But yes, I mean the group effect, or what is not spanned by the factors that we have, there's probably a good part of it that is the liquidity of those funds.
Okay, thank you very much. I think it's time to move to Gianpaolo's paper.
Thank you very much.
Okay, perfect. So thank you very much for inviting me. It is really great to have the opportunity to present here. This is the work with Mirko Rubin, who's a colleague at EDHEC Business School in Nice, and is also here today, I believe. So let me start with the motivation for this paper. So one of the key trends in asset management at the moment is the unprecedented growth in the demand for ESG investing. Just as an example, a recent survey from Morgan Stanley found that 84% of investors today want investments that are tailored to their values. And a necessary condition to basically be able to pick a fund that is consistent with your values is to be able to identify funds that do responsible investing in the first place. And there are basically two ways to do that. So first of all, fund managers can signal themselves to the investors that they are responsible. either through the name of the fund, including, for instance, some key ESG word in the name of the fund, or describing in the prospectus of the fund their investment criteria, their investment process. However, there is a problem with this approach of identifying ESG funds. That first of all fund managers, in principle, they have an incentive to claim that they are responsible, even if they are not. And given the current legislation in the US, if you claim to be responsible, you have actually very little obligation to be responsible in practice. So a way that is becoming more and more relevant in the industry is actually through third-party sustainability ratings. So these are rating issued by institutions that are not affiliated with the funds. So there's no conflict of interest. And what this institution do is basically they collect information about the portfolio allocation of the funds. And on the basis of those, they issue a rating that is going to be higher the more responsible, the more sustainable the portfolio positions of the funds are. Okay, so what we do in this paper is basically we ask ourselves how reliable are those sustainability ratings, and in particular whether funds can time their trades in a way to gain the ratings. What we have in mind here is that funds could buy responsible stocks just before disclosing their portfolio positions, but then switch to more profitable stocks that are potentially less responsible after disclosure. And we label this trade green window dressing. So from an economic perspective, the incentive to engage in this type of trading comes from the fact that you have an asymmetry between the disclosure requirements for performance and for portfolio holdings. Specifically, funds have to report their performance on a daily basis. However, the same funds, if they are located and domiciled in the US, they have to disclose their portfolio holdings only 4 times per year. And this is relevant because those portfolio holdings are basically the main input that is used by this third-party institution to determine the sustainability rating of the funds. So since you have such a large discrepancy between the reported frequency for performance and portfolio holdings, one could argue that fund managers have a stronger incentive to perform well at all times than to be responsible all the time. Okay, more precisely, this is the very simple model that we have in mind. So mutual funds have to report to the SEC their portfolio holdings every quarter. The way in which that is done is basically that the funds have to send a snapshot of how their portfolios look like at the very end of the last trading day of each fiscal quarter. Then the SEC is going to make this information publicly available with a maximum delay of 60 days. And this third-party rating institution like Morningstar are going to collect this information and use it to determine a sustainability rating to assign to the fund. The most salient of those ratings, the one that is more used by investors, is also more considered in the literature, is the number of globes. So this is a visual rating issued by Morningstar that goes from 1 globe for the funds that are the least sustainable in their investment class to 5 globes if the funds are among the most sustainable. And the average fund receives 3 globes. Okay, so this is overall a relatively long process. It can take 2 months, for instance. But what is key is that the portfolio positions held by the fund at the very end of the last trading day of the fiscal quarter are going to determine 2 months later the rating that the fund is going to receive. So fund managers have a very strong incentive to hold particularly more ESG assets at that very specific point in time. Okay. So in this paper, we basically do 2 things. So in the first part of the paper, we provide evidence that ESG funds in the US engage in green window dressing. In particular, we show that ESG funds decrease their ESG exposure just after disclosure. And the second part of the paper, we try to understand the reasons why funds engage in green window dressing. In particular, we look at effect on sustainability ratings and effect on performance, and we find a positive effect on both. So let me start with the methodology that we use. So in an ideal world, what we would like to do would be to check the portfolio holdings of funds just before disclosure and the portfolio holdings of the same funds just after disclosure. And we would check whether funds hold more ESG stocks just before disclosure than just after. The problem with this approach is that we are not able to track portfolio holdings on a daily basis. And the fact that funds are not, don't have an obligation to disclose this information on a daily basis is what creates an incentive to window dress in the first place. So we need to basically come up with a different resource design. And what we are going to use is that even though portfolio holdings are not available to us on a daily basis, returns are. So what we are going to do is basically to estimate the ESG exposure of funds from the daily returns. And we are going to focus on a narrow window that includes a few days before disclosure and a few days after disclosure. And we are going to basically take advantage of the fact that the incentive to hold high ESG stocks exogenously decreases just after the end of the quarter, which is the disclosure time. Okay, and what we try to see is whether ESG exposure remains the same just after disclosure or becomes systematically lower just after disclosure. So econometrically, what that entails is the following. So we run two identical regressions, one on the 10 days before disclosure, the other one on the 10 days after disclosure. In those regressions, we regress the daily return of the fund on the market portfolio and on a ESG portfolio. For all the results I'm going to show to you today, we proxy the ESG portfolio using the MSCI US ESG Leader Index. If you don't like this index, in the paper we show results using seven different alternative ESG indexes. But what we want to see, what we are interested in from these regressions is what happens to those two ESG betas. Basically, we want to see whether they remain the same after disclosure or whether the after disclosure ESG beta is actually lower than the pre-disclosure ESG beta. So to be precise, our null hypothesis is that the delta, the difference between those two ESG beta is 0, indicating the funds are not manipulating ESG exposure around disclosure. Our alternative hypothesis is that the second ESG beta, the one after disclosure, is lower, which means that the delta ESG beta is negative. So this approach is also very attractive in a way because we estimate those delta ESG betas at the fund level and for each different disclosure event, which allows us to then link those delta ESG betas to fund performance and flows to estimate the impact that the manipulating or like reducing ESG has on performance and flows. The cost and the complication with our research design is that we have to estimate those ESG beta on very short estimation windows, which invalidates a larger sample asymptotic, so we cannot basically realize on standard econometrics, but we develop our own test based on Bootstrap to basically test whether those delta ESG beta are statistically different from 0. And I'm not going to go into the details of the Bootstrap today in the interest of time. So this is what we find. So the first column of this table reports the average delta ESG beta for the funds in our sample. So that minus 0.10 basically indicates the funds go from ESG exposure of 0.23 on the 10 days before disclosure to one of 0.13 in the 10 days after disclosure, which is a 40% decrease. Consistent with funds, with the hypothesis the funds are decreasing ESG exposure after disclosure and therefore consistent with green window dressing. We also try to estimate the ESG beta using shorter estimation windows that give us a effect that is even larger, more negative. We also try to expand the estimation window. In that case, also the result becomes slightly stronger, but the difference is very small. So overall, all these results are consistent with green window dressing. To validate our approach, we also try to basically allocate 5,000 random placebo disclosure dates to the same funds over the same period, and replicate the same analysis. And what we find in this case is that there's no difference in ESG exposure between before and after, which means that we are now capturing some kind of trend with our main analysis. So overall, all these results are telling us that strategically around disclosure, funds are decreasing their exposure to ESG. But why are they doing that? Well, potential is that they potentially are substituting ESG stocks with stocks that are forbidden. So stocks that are more profitable, but they couldn't hold in normal times due to their ESG constraints. So in line with this hypothesis, we find both that funds are increasing their exposure to the market just after disclosure, which again, they shouldn't be holding if they're consistent with a strong ESG constraint. And also we find that they are increasing exposure to CO2 emission factors of the type documented by Bolton and Kasperczyk. We also try to conduct our analysis in a different way. So in the previous analysis I've just shown you, we basically use variation in the time series to compare the ESG exposure of a fund before and after disclosure, and basically estimating it within fund. Instead of using the time series, we can also use the cross-section. So I told you at the beginning that we cannot track portfolio holdings of funds over time, but we do know what the fund is holding at the very end of the fiscal quarter when it's disclosing its portfolio holdings. So what we can do is that we take those portfolio holdings and then we match them with the daily return of each asset that was disclosed by the fund. We take the daily return of those funds, and then basically we are able to compute the counterfactual return based on the portfolio disclosed by the fund. So that is the return that the fund would have if it was still holding the same portfolio that it was holding at disclosure. And we compare those counterfactual returns with the returns that are actually realized by the fund. The idea here is that the green window dressing should increase the gap between realized performance and counterfactual return and counterfactual performance, because funds should be switching to assets that on average pay higher returns, even though are less responsible than the assets that were disclosed at the end of the fiscal quarter. And this graph shows what we find. So on the vertical axis, we report cumulative returns. The black line shows the returns realized by the fund. The gray line shows the return, the counterfactual return based on the portfolio disclosed by the fund at time zero. What we find is that, of course, they move together because they are very similar overall. The two portfolios are very similar overall, but the funds start already a few days after disclosure to outperform the portfolio that it disclosed at time zero, which is consistent with green window dressing. Also, what we find is we estimate ESG beta, ESG exposure on both realized return and counterfactual returns. And we find that actually the ESG beta is lower for the realized return than for the counterfactual returns. Again, consistent with the fact that funds are basically trading off ESG exposure for higher performance. Okay, so all these results are at the fund level, but we also conduct an analysis at the stock level. So our idea here is that if many funds at the same time, just a few days before disclosure, start to buy the same assets with very high ESG ratings, that could exert buying pressure, price pressure on those assets, and we could be able to see some kind of price dynamics around disclosure. So what we do here is we just consider the stocks with the very highest ESG ratings, and we look, we conduct an event study on their performance around the 4 most common disclosure dates in our sample. So this graph shows what we find. So on the vertical axis, we have the average cumulative abnormal return for the stocks with the very highest ESG ratings. So those will be the returns that you would earn by setting up an equally weighted portfolio of high ESG stocks 3 days before disclosure and holding it until 3 days after disclosure. So on the horizontal axis, you have event times. And at time 0 and event time 0, you have this is the day of disclosure. So funds have to disclose at the very end of this day. So what we find is that there is abnormal performance, positive abnormal performance just a few days before disclosure, but then it reverts quickly to 0 immediately after disclosure. So this seems to be consistent with the fact that funds are exerting abnormal buying pressure on a very limited number of stocks with very high ESG ratings that is basically bidding up the price of those assets. But then funds either stop buying those assets or they start selling those assets immediately after disclosure, and the price reverts back to fundamental values. So it basically reverts back to 0. And so this is again consistent with green window dressing. I did a report here, the graph for the stocks with the very lowest ESG ratings, but we find a result that is almost opposite. Okay, so overall, those results all all indicate the funds engaging green window dressing. So in the second part of the paper, we try to understand why funds engage in this trading strategy. And our framework here is the following. We assume that what asset managers want to do in the end is to attract as much capital flows as possible. And this is because the revenues of asset managers in the end are just a function of the asset under management. And in practice, asset managers have 2 ways to make their funds more attractive to investors. They can either improve their performance, or they can improve their sustainability ratings. And in principle, green window dressing can have an impact on both dimensions. So we start looking at performance. What we do here is we take the delta ESG betas that we have estimated in the first part of the paper. Remember, a lower delta ESG beta, a more negative ESG beta means the funds are engaging in green window dressing more because they go from very high ESG beta before disclosure to a very low ESG beta after disclosure. So in this graph, you have on the very left side the green window dresser, the funds that are green window dressing the most, all the way to the right, to funds that are not window dressing. They maintain the same ESG exposure before and after disclosure, or even some funds are increasing ESG exposure after disclosure. And for this fund, for each portfolio of funds, we report the average ESG alpha for the funds in those portfolios. So this is the alpha of a fund computed with respect to the ESG portfolio. So this is a one-factor model where we use a single factor, the MSCI US ESG index. What we find is that the green window dresser are significantly outperforming both the other ESG funds and their ESG benchmark. But the relation is really like negative and linear. Basically, the less funds engaging in window dressing, the lower their performance with respect to the other funds and with respect to the ESG indexes. Okay, so overall, we find that green window dressing has a strong positive effect on performance, as window dresser outperforms the ESG index and also the other ESG funds. However, which is quite striking, we find that window dressers are not able to outperform the market just by window dressing. So if we replicate the same analysis I showed you before, considering CAPM alpha rather than ESG alpha, what we find is that we still find a negative linear relation, but then in this case, the funds that are green window dressing the most, they achieve an alpha that is roughly equal to 0. It's a bit lower 0, which indicates that even by window dressing, at the very best, they can perform in a way that is similar to the performance of the market, which again is consistent with the result I showed you before, that after disclosure, the window dressers are basically just substituting the ESG portfolio with the market portfolio, which allows them to move much closer in performance to the market portfolio, but doesn't allow them to do better than the market portfolio. We also find a positive effect on sustainability ratings, in particular when we consider the ESG betas estimated on the 10-day window before disclosure. We find that they have a very strong predictive power on the sustainability ratings that the funds are going to receive 2 months after disclosure. However, the post-disclosure ESG betas, those estimated on the 10 days after disclosure, are not related to the future ratings that the fund are going to receive. And that, again, is consistent with the fact that after disclosure, basically fund managers can expand their investment opportunity set, because the assets they are going to buy are going to matter for their performance, but they are not going to matter for the sustainability rating that they are going to receive. And overall, we find that thanks to these effects, the green window dressers are able to attract much higher capital flows from their clients. And this result in particular is driven by funds that are marketed to institutional clients, which may suggest that institutional clients are actively chasing green window dresser, because that allows them to basically still claim that they are investing responsibly, but it doesn't cost them in terms of performance, because in a way the ESG constraint is not really binding for those funds. So overall, concluding, in this paper, we show the funds moving in and out of responsible portfolios. They do that with 2 objectives. First of all, to look more responsible than they really are. And second of all, to improve performance with respect to the ESG portfolio. This has 3 main implications from our perspective. First of all, we all use for research and also in the industry, basically information that is disclosed by institutional investors to determine their degree of sustainability, but our results suggest that those portfolio holdings are probably not completely reliable, and they may be biased in a way that makes funds look more responsible than they really are. As a consequence of that, also sustainability ratings that are based on that information on those portfolio holdings are maybe less informative and less reliable than we used to think. And finally, the third point is that institutional clients may actually take advantage of green window dresser to basically go around their ESG mandate and basically still claim that they invest responsibly, even though in a way they hold funds that invest in basically they have an unrestricted investment opportunity set. Okay,
Thank you.
That is all I have. Thank you.
Thank you, Gianpaolo, for a very clear presentation. So we have a few minutes for questions.
I have a question, actually, if I can. Okay. Can you remind me, Gianpaolo, how you define your ESG funds? Is it based on the title or on the prospectus?
Both. On both. Yeah.
And is there a difference between, because I would think that those who advertise themselves in their title are probably more salient than those who advertise as themselves just in the prospectus. Is there a difference between the 2 types?
That's a great question. Is something we did test at some point, but now I don't remember. I think it's still significant for both of them, but indeed for one group of funds was more prominent than for the other. But now I honestly don't remember for which one of the two it was.
And along
but
the same
you may be
lines,
right that
yeah.
You may be right that if it is in the name of the fund, is even more salient. So it is even more important to them to basically to look responsible, sustainable, also according to the ratings. Yeah.
And I have a very related question, which is on the Morningstar and the Globe rating. So there's papers showing that upon disclosure of the Globe rating, the 5-star and the 1-star rated funds are the ones that have the most variability in terms of flows. So I'm here, presumably, if they're changing their allocation, it's like to win one Globe, probably. So is there a difference between those funds which achieve the 5-star Globe, the 5 Globe rating and the others?
Yeah, you're completely correct. So actually, we find that the result is almost entirely driven by the discontinuity between the 5 Globes and the 4 Globes. So these are funds that have 4 Globes, but they can trick their portfolio a little to basically end up earning 5 Globes.
So that's what could be expected, yeah.
Yes, indeed, like the effect should be also very strong between 1 and 2 Globes. But since these are ESG funds, very few of them, they have only 1 or 2 Globes. Some of them do, which is surprisingly, but yeah, we don't find a significant discontinuity between them, probably because we have too few. But yes, most of the result is really driven by the discontinuity between 4 and 5. Yeah, thank you.
Thanks.
Thank you for the question.
So Gianpaolo, I have a question. So how should we think about your results? I mean, are they like growing pains of the responsible financial industry, like mistakes that the rating agencies would make, or is it because the investors have difficulties confronting the fact that responsible investing means low returns? I mean, how should we think about this these results looking ahead?
Yes. Yeah, that's a very difficult question. Well, our sense, I think Mirko would agree. I mean, what we find here is that this result is basically beneficial to all parties. It's beneficial to the fund manager. It's beneficial to the client. So it is rational from the perspective of the fund manager to engage in this type of strategy. At the moment, in the US, there's no regulation that prevents them from engaging in this type of strategy. So it is almost a policy question, well, like whether we should be intervening or not. Of course, this is not optimal from a welfare perspective, because if clients really want sustainable investing, this is clearly not the way to achieve it. I want to be very clear, since Morningstar has already been contacted about our paper, so we are not blaming Morningstar. We think like Morningstar is doing the best with the information that they have. But there is this very strong asymmetry between the disclosure frequency of performance and the disclosure frequency of portfolio holdings. So with the information that we have on portfolio holdings, it is difficult to do much better than
I'm not criticizing your paper. I was just asking a broader question. I mean,
I understand. Just I want to be very cautious on my.
If I can follow up on Laurent's question, there are other papers that document, older ones, that document window dressing of funds that do not really belong to a given category, and yet they appear to do so. Is there something peculiar about sustainability going forward that one would like to dig into, like in the external?
like, I mean, clearly, like our paper is very related to those like older paper on we call it traditional window dressing. I think there are two key differences that makes our result in a way different and interesting. So first of all, the impact on performance. So like it's quite clear from previous papers on traditional window dressing that traditional window dressing has a negative impact on performance. While what we find is that it has a very strong positive effect on performance. And the second difference is the economic channel. We find very clearly that our result is driven by the desire to manipulate the sustainability ratings. Like we also find no results whatsoever before if we replicate our analysis before the inclusion or before the introduction of sustainability rating. While all the other type of traditional window dressing is driven by completely different incentives, that it doesn't have an impact on any type of ratings. So also from an economic mechanism, it is really different for these two type of trending behavior. So these are the two key differences I want to stress.
So are there funds that, because it seems to me that one solution to the problem that you've discovered is funds would commit to only invest in certain types of assets, right? So they would they would restrict themselves and they would restrict the type of assets they allow themselves to invest in. Are there funds like this that you can look at? And then a related question is: do we think that investors are willing to accept, right, the cost of being serious about responsible investing? Okay.
So to my knowledge, there are very few funds that really commit to not invest in an asset in those circumstances. I mean, there's been, to my knowledge, only one case in which a fund clearly violated a commitment in the prospectus, where the SEC actually intervened. But in any case, even if funds were making such strong commitments, we don't see what happens within a quarter, so we wouldn't be able to say that funds violated that particular commitment to investors. To your second question, what we find is that there is a clear difference between funds that are marketed to retail investors and to institutional investors. So retail investors, they don't seem to respond much to green window dressing, which to our view is consistent with the fact that retail investors that choose ESG funds, they do that because they really want to invest in ESG funds. They are maybe potentially even willing to forgo part of performance to invest in a way that is sustainable and welfare improving. The problem comes from the institutional clients. The institutional clients, they have two very strong incentives to basically advertise that they are sustainable, but they are evaluated on performance. So they are, I don't know, there is a trade-off here where it's very difficult to quantify it.
It's very useful. Thank you.
Thank you. Thank you for the question.
There's a question from Elise, no? No, it's Tim. Sorry, it's a message to me. Yeah. Are there other questions? No, about both papers actually. No. Okay, so I think we're reaching the end of this session. I think it was very interesting. Both papers were very insightful, and we wish you a happy holiday season, and then we reconvene in the new year. So thank you very much, Elise and Gianpaolo.
Thank you.
Bye.
Bye. Bye.
Thank you very
Bye.
much.